The performance of the U.S. workers' compensation line has exceeded other commercial property casualty lines, but still remains vulnerable to headwinds, according to a recent AM Best report. These negative factors include rising medical costs, reserve shortfalls, and higher average settlements from ongoing litigation. I'm John Weber for AM Best TV. We're joined today by David Blades, Associate Director, and Director Jacqalene Lentz, co-authors of a recent Best Market Segment report on workers' compensation. And David, how have recent unemployment levels and payroll growth impacted the workers' compensation segment?
Well, John, workers' comp premiums are basically computed by applying a base rate for different classes to the payrolls of different insureds for those classes of business. Now, workers' comp rates have generally been declining over the last several years, definitely since 2015, but over the same time, workers' comp premiums have been increasing basically for most of this decade, during the same time that unemployment rates have been going down. So with payrolls increasing across the country, businesses across the country, what we've seen is that the premium growth in the workers' comp segment has been enough to overcome the declining rates, and that's what we've seen driving the overall premium increases. So the unemployment rate, so the decline in the unemployment rate has been enough to offset the declining rates. And what we've seen, actually, even from the NCCI has reported that payroll growth has had a positive impact of 4.4% on the overall premium level. So again, that shows the impact of the declining unemployment rate on overall premium levels for the workers' compensation market. In 2017, we did see workers' compensation direct premium volume decline by 5%, but that was largely because of the average rate declines.
Now, the report notes that claims frequency has declined, but severity is on the upswing. What's driving that?
Well, definitely. The decline in lost time claims has largely been due to improvements in workplace safety. The improvements that companies have made and the investments that they've made has been considerable and been part of overall strategic planning. It's manifested itself in enhanced automation, robotics, and general overall improvements in risk management. So that's what we've seen. There's also been effective reform aimed at addressing increasing workers' comp costs and abuses in the system that have resulted in insurers paying lost time claims, for example, to workers who could have and probably should have been back to work. So the effective reforms and also overall workplace safety has had the positive impact on loss frequency. Now, again, while loss frequency has been trending positively, loss severity has definitely been declining or going in an adverse manner, and that covers both medical cost severity and also indemnity severity, although medical cost severity has really been the key driver of severity going in the wrong direction. What we've seen, for example, one factor in that is motor vehicle accidents. We've seen more motor vehicle accidents that have involved workers, and these claims, these increasing number of claims have included fatalities, and that's occurred despite the fact that we know newer vehicles are definitely being made with more safe and stronger materials, and also there's been all kinds of safety improvements with those vehicles, but still we've seen a greater number of motor vehicle accidents impacting workers and having an impact on workers' comp severity from that standpoint. In particular, the class of business that have been impacted by motor vehicle accidents have included long and short-haul trucking, taxi drivers, and also sales and service vehicles. So we've seen that over time, again, having an impact on the motor vehicle accidents and the impact on severity. In addition, and this has been impactful that we've seen for both personal lines and commercial lines in terms of personal and commercial auto, increased smartphone usage has also had an impact on the losses that have affected workers' compensation or workers in terms of severe accidents. And we'll see how those trends continue on a going forward basis.
Jackie, how have reserve releases played into a lower combined ratio for the segment in 2017?
John, the workers' comp underwriting has been performing very well of late. For the last several years, we've seen the combined ratio in the low 90s. and we fully expect that to continue through year-end 2018. In 2017, we saw approximately $6.6 billion of reserve releases for the loss ratio. That brought the loss ratio to about 48.6%. That was 4.7 points of favorable treatment over prior year. Now, the loss adjustment expense and underwriting expense had a slight uptick over that time frame, but that was really not enough to offset the benefit of the reserve releases. And, we're seeing the improvement in this loss ratio due to better modeling of risk, better predictive analytics, just improvement in proactive claims management. But I will say that we are going to continue to monitor the loss ratio very closely in the coming year to see if rate decreases, which have been the norm of late, are going to pressure the loss ratio in any way.
Let's talk about that coming year. What issues do you expect AM Best will be keeping an eye on for the workers' comp segment as we move through 2019?
So there are a host of issues that we're going to continue to monitor and talk with companies about. Innovation, first and foremost. Innovation in terms of underwriting risk and claims management, claims handling. Also, innovation in data management, predictive analytics, and whether this is driving some of the favorable improvement where we continue to see in the combined ratio for workers' comp. I think we're also going to monitor innovation in terms of the Internet of Things, and for workers' comp specifically, we're talking about wearables. Is this driving some measurable safety improvement in the loss ratio for workers' comp? We're going to continue to monitor severity, as Dave mentioned. We're also going to monitor rate actions, and up to this point, there's been significant rate decreases, so we'll continue to watch that. We will also look at economic conditions and the potential for increases in minimum wage, as Dave mentioned also. And then lastly, I think we're going to continue to talk to companies about medical and recreational cannabis, its impact on the workers' comp line from a safety perspective as well as from a claims treatment perspective, and whether it is something that can be used as an alternative to opioids.
Thanks, Jackie. David.
Thank you.
Thank you.
You can find the full report online at ambest.com. And for AM Best TV, I'm John Weber.